and welcome. I'm Amy Maxwell from Citywire, and I'm pleased today to be joined by fund managers Alex Ralph and David Roberts from the newly established Palomar Fixed-Income, the first in-house boutique powered by Nedgroup Investments. This is the third episode in a three-part series designed to introduce Palomar Fixed-Income, the people behind it, and the strategies within it. A warm welcome to you both.
Thank you.
So in this episode, we're going to be getting into the detail of how the fund works. And I'm going to row back a little bit to start with the idea of the strategic or unconstrained bond sector. Do you think there are any drawbacks to having such great flexibility? And could that be what's driven some of the outflows we have seen in the sector?
Yeah, because we've seen, as mentioned, that interest rates in the last 10 years, thanks to QE, has been, at rock bottom, and therefore that's really encouraged certain funds to go to the more, dark parts of the market, and that's really generated quite a disparate collection of funds in the sector. So, as David said, we really do want to reassure investors that we are looking at the core part of the market.
Can we remind ourselves, why should investors consider allocating to a global strategic bond fund such as the Palomar Fixed-Income?
Well, for us, as we're returning to this old normal where QE disappears and we get QT, and then we actually think that bonds behave like they used to pre-10 years ago, that actually you'll see a bigger dispersion between the asset classes within the bond sector. So you'll see high yield rally when we come to growth in the economy. We'll see government bonds rally as you come into a recession. So we'll actually see the different classes acting as they should, unlike the previous 10 years where they all rallied together. And therefore the allocation between those asset classes has become pretty vital. So we think the Global Strategic Bond Fund, which has suffered outflows, as you said, will actually become a more attractive option for investors, because you'll be able to hand the call over to people who've been through this cycle before.
Yeah, I see that another couple of advantages, just picking up on that again, as Alex has said, the good thing about starting with yields where they are is that in a more normal cycle with, again, this move away from QE, then the chances are that bonds and equities will be lower correlated over the next few years than they have been for the past decade. So hopefully, not just in strategic, but generally in bond investment, it gives people, again, the opportunity to diversify their portfolios. And then the final thing I think I would add would be that we are truly a global strategic fund, and one of the advantages of that is if we don't like the domestic UK bond market, and people are quite worried about the amount of gilt supply, about UK fiscal situation, then a proper global strategic fund would allow investors to take advantage of the global bond market and bond returns rather than losing sleep over what's going to happen with UK public finances.
So it's really fantastic news that bonds are back as a diversifier for investors. Let's talk about your career track records and understand kind of your expertise and how you leverage that skill set for investors.
Well, yeah, I mean, I've been doing it for like more decades, never mind years, than I care to remember. Been through a number of financial recessions, seen bonds being in favour and out of favour. But I would say if we just focus on like the last 10 or 15 years or split it into two periods, so that in my career, like 20 years before QE was I would say, as far as bonds can be, quite interesting. So we could always come in and find an opportunity. And then as soon as QE arrived, it was just everything was moving in one direction, and the opportunity for active management was really limited to how much risk are you going to take. There wasn't really much to it other than that. And then, again, as we've said a couple of times, now we're moving back into that world where central banks don't dominate bond patterns, bond market moves. I think Alex and I would agree that gives us a real opportunity, again, as active managers, to find lots of opportunity rather than just play that market direction, which gets a bit boring after a while.
And it's also interesting because both our backgrounds, if you look at our return profile, they've been very much, we're both fund managers who've really looked at risk as well, returns relative to risk. And you can see the performance comes across through those statistics. And also interesting because my background's very much stock selection, credit, bottom-up kind of analysis, whilst David's is much more macro-driven. So to come together to produce those kind of returns from both angles is really helpful, we believe.
And so picking up on that track record, so you've both between you've been in the market from the 80s up until the 2020s, and you've navigated 6 recessions and 7 bear markets. So, is it fair to say that you've seen it all? You've had to allocate market stresses like the financial crisis, Brexit, pandemic.
Yeah, I mean, I think what we would say is we're not probably naive or have big enough egos to believe we have seen it all. The market can always just throw stuff at you, and again, that's part of the reason I think that we quite enjoy working together, because when we've looked at, we did a bit of due diligence, as you would, and the way that we've managed money and the results for clients have been quite similar over the decades. So similar levels of return, and in each case taking probably less risk than many. So there's a similarity there. So that's quite nice that we knew that we would have individual styles that would blend quite well together.
And this boutique setup, I imagine, is beneficial for you both?
Yeah, it's very beneficial actually, because we both manage money on small teams, and personally I much prefer managing money on a small team. You've got a very nimble process, you can make decisions very quickly, you don't make a decision through credit committees, and you can implement your decisions very quickly. And considering the market is so volatile, we feel that it's best to have that decision-making process match the market essentially and how it drives and moves. So yeah, for us it's a much better way to invest.
So it certainly feels like a fitting partnership and set up an offering for a market environment which is returning to the old normal.
We'd like to think so.
Yeah.
Okay, excellent. Well, thank you both for joining me today.
Thank you.